Unorganized space is a plethora of opportunities.
Thanks for tuning in to Alpha Moguls, a show where we speak to some of the finest investing minds about how are they viewing the current investment landscape and what are they doing with their current and potential investments. Our guest today is Manish Sonthalia, CIO of Portfolio Management Services at Motilal Oswal Asset Management. Manish, a pleasure having you. Thank you so much for taking the time out. Now, inherently, you are a bull. But 2018 is not turning out to be a year that is that great for the bulls, at least the first 2 or 3 months. How are you viewing the current investment landscape?
So we have seen these sort of times many times in the past, given that I've been in the stock market for the last 25 years, so nothing really moves us that badly, we are made of, we don't have nerves of steel, we have nerves of titanium. Okay, so nothing really shakes us. So it's a part of an ongoing correction. We'll see some more correction maybe, people with some, if there are excesses on the downside, there will be excesses on the, if there are excesses on the upside, there will be excesses on the downside. We saw excesses on the upside at 11,000 something on the Nifty, clearly these were excesses. Now we are approaching a situation where there are excesses getting created on the downside. So, these are how tops and bottoms are made. So currently the base formation is underway, maybe it will fall another 5% or thereabouts. Thereby, you'll see far more rationality come through in the market because earnings are picking up. And the ultimate truth in the markets and stocks are earnings. PE multiples are in nobody's hands. They were not in anybody's hands when the markets were going up. They are not in anybody's hands when the markets are. You have got to actually factor in all the negatives at a particular price level. And I think we are somewhere closer to the bottom. That's how I would look at it. Nothing to get very panicky about all these things.
Well, that's good to hear. But just wondering, Manish, it's a 1,000-point fall that we've seen from the highs. You are saying that this is excessive?
I mean, 1,000 points on the large cap. But if you was to see the broader markets, there are stocks which have fallen 20, 30, 40, 50%. I mean, these are clearly excesses on the downside. Don't really think that there was so much of froth in many of the established marquee names. Yes, they have gone through multiple corrections, like PE multiple corrections. But nothing to warrant this sort of a panic. I think it's got to do with the negative flows that have come through from RBI's front on account of the PSUs, liquidity issues, and so on and so forth. But my personal sense is that we are, creating excesses on the negative side. So, these sort of things really won't last too long. If the earnings growth is there and capital will always chase growth, we are approaching that sort of a situation currently.
Okay, awesome. So let's try and think about what could happen in 2018. It's been about a month and a half since we had the budget announcement. I remember when the markets fell quite a bit in the month of February, we had you twice in 2 days on air talking about, whether or not there is some problem here, so on and so forth. 2 or 3 things, and now that we've had some time to reflect upon it. One, the fact that the PE multiple re-rating story could stop or peaked out in 2017 maybe, might just come to a halt or a bit of a downtrend. And 2, the hurdle rate has gone up by virtue of the fact that there is a 10% tax on equities as well, which was not there in the past. Does all of that lead to your mind, a bit of a lower PE price to book, ROE multiples for India compared to what was, say, in 2017?
100%. So, if you were to analyze the last 5 years' numbers, globally, we have the global trend has been that there has been lower oil prices and cost of capital has come down, right? That has led to a massive PE re-rating all over the world, including India. India has been a beneficiary of that. What you have seen in terms of earnings growth, hardly anything, maybe 4.5%, 5% CAGR. We saw massive PE re-rating, right? All of that has come to a standstill now. That's not happening anymore. In fact, the macros are all turning adverse. The current account deficit is turning adverse, the fiscal deficit is turning adverse, political situation is not good, inflation is going up, everything. All this will weigh on PE multiples. So how will it weigh on PE multiples? It's basically the cost of capital is going to get elevated, right? First, you have the capital gains, which you said will lead to expansion in the cost of capital. And then the macro issues, the inflation, etc., means yields are actually going to rise. Cost of capital should come down. Same cash flows, if you discount by a higher cost of capital, your P multiple, that's exactly what is happening. The silver lining is that we were in an environment of negative earnings growth, of very little earnings growth. Now we are in an environment of good earnings growth going into the future. And what we have seen is that the technical issues regarding capital gains and political issues, these may be technical issues. Ultimate truth in the market is earnings growth. And if the earnings growth come through, you wouldn't see too much of a downside. And I think there's greater conviction in believing that earnings growth is definitely underway. What we didn't seen in the last many years is now playing out. It started from Q2, Q3, Q4 is going to, and hopefully, let's assume that FY19 is going to be a continuation of that. So that's how I would read into this entire peaking out of the markets at 11,000, maybe going down. I think India has a long way to go. I mean, these are all basic macro stuff, but the nature of the earnings composition will change. So some of the sectors will not report good numbers, but some of the sectors will report good numbers. But by and large, the consumption savings story stays intact, and it's only going to pick up momentum as we progress into the future.
Okay, just some numbers. I just want to dwell upon it for a bit, Manish. Q3 was a quarter of earnings recovery. Ex-banks. Banks had a problem. Q4, we know that banks will have a problem. Now, we can all argue and have read reports which say that, oh, yes, banks posed a bad number, but ex-banks, we were great and therefore we are bullish. But clearly it doesn't work that way, right? The Nifty EPS, if the banks come out with a washout quarter, will get impacted a bit. And while that may resurrect itself in FY19, the base of FY18 is lower, and therefore the resultant number in FY19 could also be a bit lower than what was anticipated earlier, right? And we are in a stage wherein P multiples will not be as high as they were, say, for calendar year 17. So what numbers are you working with when it comes to these earnings? We were talking to the SBI chairman before we did this interaction, and he was of the opinion as well that quarter 4, it's difficult to quantify, but there will be a substantial hit that will come in for all banks by and large, but FY19 will be normal.
So what you're saying is absolutely right. Banking as a part of the index is roughly around 40%, right? And within that, a larger weightage is given to, let's say, private sector banks and lesser weightage. So, the exchanges in our country have a beautiful mechanism. There's resurrection in the index per se to suit the indices, to suit the sectors which do well, and to remove those sectors which don't do well. So, you talked about the banking sector, etc. So 70% of the banking system is PSU. There's a problem. There's going to be market share shift, right? That is all going to play out in the private sector names, right? At the end of the day, with all the PSU banking problems, the economy is still growing at 7%. Right? So pillars of the economy are savings, consumption, investment. Somewhere these numbers are going to fit in, either in savings or consumption or investment. You got to find out what works. Which are the names which get benefited, which are the names which don't get benefited. As a part of corporate India, what has been the earnings growth? Which of these part of corporate India is a part of the index? That's how all the numbers stack up.
Okay.
So, the percentage of PSU bank, let's say, which will be a sea of red going into Q4, is minuscule.
And the weightage is even smaller.
Yeah, is minuscule. The weightages come down, and it gets reshuffled over a period of time, that the weightages on the private sector banks are abnormally high. Even though the banking system is 2/3 or 70% in favor of PSU banks. Yes. So that's how the entire mechanism works.
Okay. Now, before we get to some specific pockets and trying to figure out how will you generate alpha in your portfolios, and a public portfolio manager has a much difficult job than some of the private investors, but just one broad macro question. Does this constant rhetoric of trade war worry you? Because we now know that while US has done what it has done, it's just started with a small step. China has made some serious comments about how they will retaliate in a meaningful way. EU made some comments, you don't know how it will work out. But some of the export-oriented countries will get impacted. And the belief, at least in the December quarter, was that in calendar year 18, GDP, global growth GDP will move up, and all manufacturing or all exporting within India will see the capacity utilization moving up and therefore benefit. Will that get challenged? Does it worry you?
So this is an era, is this reverse of liberalization. Right?
Yeah.
We are in an era of protectionism, and this is prevalent globally. Not only started with all over the world. So every country will have to suit to the changed or the environment per se. Thankfully for us, we are a domestic-centered economy. Our exports is just about 15-16%. 85% is all whatever we produce, we consume locally. So we are not going to get impacted that very badly. But yes, if there are trade wars, there is protectionism, there are tariffs, etc., everything would get impacted. Global growth is actually going to come down. Cost of doing business is going to go up. Inflation would be on the rise, and so on and so on. In an overall view, I think it's going to be negative for business environment per se, and that is probably what the market should also reflect. That's what getting reflected. It's not good that we enter into this protectionism era. It doesn't work well for either economy or markets or companies, whichever way you look at it.
But it doesn't keep you awake at night.
No, it doesn't keep me awake for the simple reason that, if you were to look at the portfolio, bulk of the themes or the stocks that we play in the market is basically on domestic consumption.
Okay.
There'll be pockets where you are looking at exports or et cetera, et cetera. But I think the risk and the reward is to be weighed at all given points in time. And even after considering in these sort of changed environments, what do? We actually question our assumptions much more conservatively.
Okay.
Let's assume that there is a tariff. Let's assume that the volumes of export are going to come down by X. Then what is the earnings? And then what is the P? Whether this fit into the margin of safety which we are, all those things.
So let's talk about how are you challenging or questioning your assumptions when it comes to the consumption space, because you clearly sold on that.
Oh, absolutely. And I have always maintained that consumption has a long way to go into in India. It's one of the basic pillars of the Indian economy, not only durables, but even staples. And this has to do with increase in per capita income and people migrating to cities, etc. So discretionary spend is actually going to grow. And even within the staples is going to be premiumization, which is going to drive growth. These are very good businesses. These are high cash flow generating businesses where, you don't require that much more capital to reinvest to generate. So, dividend payout ability of these companies stay very, very good. All these years when we were in a deflationary, or let's not call it deflationary, disinflationary environment where oil prices, etc. were falling, it was more to do with only volumes growth. Right? Now in an inflationary environment, it's also going to be pricing growth. Right? And with, let's say, both the pricing and the volumes come through, is going to weigh positively on the top line. Trickle-down impact will flow into the EBITDA and the PAT. So the growth for consumer names works positively in an inflationary environment more than what it plays in a deflationary environment. Of course, out here, creation of jobs is very important, which is anemic in our country, and let's say private sector capex. These are the two missing points in our economy. It's not happening. It's going to be about market share shift in a GST environment. Right? These three things boil down into specific stock pickings. And you try to hold it for long periods of time. That's what it is.
But you would buy them afresh because you would have a large portion of your portfolio in consumer names already. Are you putting fresh money to work out there in that pocket?
Yeah, absolutely. If
different names or the same names?
No, even different names. Many of the large cap names also would be considered very favorably. Just to give you an example, Hindustan Lever today, being such a large company in the FMCG space, have you seen the volumes growth, what they have clocked? 12% volume growth. On a very large base. How is that happening? So premiumization, penetration, distribution, these are the areas where they are working on. Plus GST benefit. Can you imagine, let's say, Hindustan Unilever clocking a 20% earnings growth? Even if you have bought it slightly expensive, how does it matter? There's a long way to go. So longevity of growth creates wealth for people in the stock market. It's not your buying price. How much of cash flow this company is going to make over long periods of time? If you buy high quality businesses, even at slightly elevated prices, nothing will happen. But if you have businesses which are broken business models at a fair price also, that's going to be destructive for wealth creation.
So in the consumption space, you're seeing high quality businesses, cash flow generating businesses coming up and giving you opportunities. And which is part two of my question, is that why these businesses are trading at such significant premiums to their long-term averages as well. We just did a study wherein HUL, the long-term 5-year average PE, the 10-year was even lesser, but the 5-year average PE at 44, that's trading at about what, 60?
No, something like 50, 55.
55 times, yeah, right?
1 year forward numbers.
Yeah, so that's not cheap.
So it's not very cheap, but can it become cheap? Of course, when market falls, everything can fall.
Sure.
But the point to ask is, or the question to ask is whether after falling, these stocks will actually go up. If you have broken business models, they will fall permanently. But these companies, because you are front-ending the growth in terms of P multiples, the growth may remain stagnant for some time. Like what's happened in Nestle, when there was no growth, the stock didn't tank. It went through a time correction. So Hindustan Unilever may go through time correction, right? You not see too much of damage in price correction. As and when the growth picks up, there will come a point in time when the next round of growth looks very cheap. So let's say 1,300 rupees, it stays here for let's say 1 year, okay, and a 20% growth. Suddenly it becomes 40p. Maybe it will stay there for another 1 year. I'm just making a hypothesis, right? It becomes a 30p. At 30p, you say there's still a long way to go. In the case of what happened, you just went through time correction. Of course, that's an opportunity lost, but you'll have to take that call into buying good businesses or great businesses at a fair price or a great price, vis-a-vis buying businesses at bad businesses at a very cheap price. That's a call you have to take. That's your style of investing.
Sure.
I'm not saying what is right, what is wrong.
Of course.
There are different styles of investing. Somebody may want to buy something which is valued at rupees 10 at 2 rupees and still make money saying that I bought at 2 and sold at 10, but it was, I don't care about that business. Maybe a good business, maybe a bad business. That's one style of investing. Contra, deep value, whatever. I'm not in that camp. I'm buying something which is, let's say, at 10 rupees. Maybe I'm buying at 7 rupees. That sort of margin where I don't have too much of margin. But I know this 10 rupees is going to become 100. And I've got to play that journey from 10 to 100. That's my style of it.
Sure. And by the way, viewers, standard disclaimer, HUL was by no means a recommendation out here.
There was no recommendation.
There's no recommendation. Just one more follow-up on that, Manish. So consumption can be broadly bucketed into multiple sets of stocks, right? One is FMCG, and you illustrated with an example of HUL as an example. There is consumer durables. There is also this whole consumption of articles, so QSRs, liquor companies, etc., which have now become a larger portion than what they were. What about those buckets? I mean, do you find favor there too?
No, so, you have two buckets. One is a consumer discretionary space, one is a consumer staple.
Yeah, I just broke discretionary into two.
So you even have autos in consumption, okay, you have liquor in consumption. So these would all be a part of discretionary, which is not, see, I'm bullish on both the discretionary, both the non-discretionary as well as the discretionary space, in the consumption space. You got to pick and choose as to, what is the market share, how is the market share going to move, competitive advantages, how long those competitive advantages, what is going to be the growth rate, what is the price that you are paying, etc. So nothing is left out as far as my favoritism is concerned, whether in the consumer discretionary space or the staples. I like the entire consumption space. It's pick and choose between them.
Okay, let me ask you, the generalized comment that people make is that the listed space probably constitutes the top 5, top 10 within the country at large. And if you're talking about GST and share shift from unorganized to organized or from small to the stronger, then almost all listed will benefit if they are run well. Some of them will benefit a lot more than the others. Would that argument be all right in the consumption space?
100%. Because, the vast majority which are not in the unlisted space are in the unorganized space. And if you are talking about shift between, let's say, unorganized and organized, it's the listed entities, which are going to benefit disproportionately. Now, within the listed entities, what we got to find is some company which is very small at this point in time, capturing this opportunity of shift, how big it can grow, and whether he can execute to perfection.
Are you finding such opportunities?
Absolutely, it's there. It's there.
Within the consumption space?
Yes, absolutely.
Okay. So that's one. The second set of companies are the exporters, right? I mean, the hope was that the global GDP moving up, all exporting will benefit. Now, two of the principal names which are given as examples always have had chalk and cheese moves in the last 6 months, Pharma and IT, both neglected for the longest time. Pharma still not being able to generate returns. Mid-cap IT, arguably even large-cap IT, but mid-cap IT has shown some real merit and grit in the last 6 odd months. What's your position on these two pockets?
I'm positive on both these names.
Both.
Right? Yeah. For the simple reason that yes, you had problems in both the sectors. But the thing to understand is that these are due to specific reasons. Within the IT space, it's not a structural, downturn. It's a cyclical downturn, right? And we have seen that cyclical downturn has started to move higher or turn. That is what is reflected in the numbers. Except for the BFSI space, none of the other verticals, domains are doing badly. It's either, high single-digit dollar revenue or, let's say, low double-digit dollar revenue. This sort of growth. In the current environment scheme of things, it's perfectly fine to have those sort of growth and to buy them at those multiples at which the markets were throwing those stocks, right?
Were throwing.
Yeah, worth throwing. But even today, they are not exorbitant. If you compare the overall extent, let's say the index of the market will be 25p 1 year forwards. Right? Whether you take large cap, small cap, any mid cap IT name, which of them will be at more than 25p? They are not.
No.
So are you buying it more expensive than the market? No. Clearly, is the growth going to be better than the market? 100% yes. So there is where the benefit comes to. As far as the pharma name is concerned, of course, it was quality control issues coupled with price erosion, which has weighed on the P multiples, right? But is the story over? I don't think so. Because India is going to be a leading player when it comes to supplying generics to the rest of the world. The ways of business is going to change. It's going to be about volume growth as opposed to pricing growth. You have far greater competition. Margins are going to come down. The size of the opportunity still remains, and we are very good at chemistry. Our chemistry skills are good. We will be able to make money, or the Indian pharma companies will be able to make money. But there will be consolidation. There were far more pharma companies than what is required. Maybe something like 40,000, pharmaceutical companies in India, with clamp down on the domestic front as well. Generic plus. We are somewhere close to the price erosion damage. That is coming to an end. Maybe within the next 2, 3, 4 quarters. One big blow up in the US. You'll have people clamoring for consolidation in the space because excessive damage on price erosion could have led to one of the bankruptcies in the large pharma companies. All of that is waiting to happen. And again, it will be a base forming process where the beneficiaries would be Indian pharmaceutical companies. So we have now come to a point where this is basically very deep value. Now, you got to wait for some time, but that is how opportunities are found. Is the story over? I really don't think so. And then you have some of these diagnostics, or let's say only domestic focus, CRAMS, etc. These are in any way growing magnificently. So
what do you buy? Do you buy the Sun Pharma, Lupins, Aurobindos of the world, which have the US exposure and have been beaten down? Or the Alchem Labs or the Thyrocares, which, well, because of the domestic focus, really haven't been beaten down?
Yeah, so, Alchem Labs is more like a consumer franchise. Right, it's branded generics in the domestic market coupled with an export business. That's doing very well. Again, some of Sun Pharma, because of its overseas presence, I think has been beaten down way beyond what the valuation should be. That creates an opportunity. We have specific opportunity even in the diagnostic space and the CRAM space, where the risk is to reward appears. So I have many names across the portfolios. The large cap names also, the consumer domestic names, as well as the CRAMS and the diagnostics.
Okay. The sector which has been bombed out undoubtedly is the PSU banking space. Are you looking at it at all?
It's beyond me.
It's beyond you.
No, so the whole problem is, the dimension of the problem keeps on changing. Right? We started with, let's say, 10% of the banking system being NPA, and you have a provision on that count, so you are left with this amount of shortfall which has to be bridged by way of capital infusion, etc., etc. We thought that 2,13,000 crores, if it is infused as capital, would solve the problem. You have a new RBI circular. Now the amount of stress in the system is anywhere between 15 and 20 lakhs. Where does the capital come from? And is it the end of the road as far as the recognition of the problem is concerned? I don't know. So if you are not able to understand the extent or the damage which is to be there, how do you take a call on valuations? There will come a time when there's screaming value to it, but as of now, it's like a bottomless pit. Can't really think of the extent of damage. We'll have to change our stance as and when the situation arises, when you get a sense. But my sense is this whole thing is not going to get solved before 2020. The complexity of the problem is not going to end anytime soon. In fact, it might just see a sharp shoot up and then maybe it starts to subside, but I'm totally away from PSG.
You're almost extending a sigh out here right now, Manish.
No, because 2 years ago, I was mentally prepared that 2 years down the line, things are going to be very different. It's going to be very positive. And this was the thought process in 2016. We are in 2018. We are in a bigger problem.
Yeah, true.
So trying to predict next 2 years when you know that, a whole lot of things are happening in this space.
Okay. So then the second question is, and you spoke about time correction, which brings me to this. The private sector banks, corporate facing or even the high CASA banks, retail focused banks, have had a time correction for sure, right? For everyday anchoring leads me to see HDFC Bank being in that 1700 to 1900 range now for donkeys of weeks. Kotak Bank has been stuck out here, and these are quality franchises which have been in this very narrow band for a really long time now. Does this time correction give an investor an opportunity to buy something which is expensive but is quality?
Yeah, so there will be periods when quality goes through time correction. It's better than losing money. Let's say if you bought a private sector bank vis-a-vis buying a PSU bank, you would have lost money on a notional, even though on a notional basis vis-a-vis this. I think it's got to do with surety of your thought process. There's going to be market share shift in the private sector names, right? They are going to gain at the expense of these guys. And the quality of the franchise remains very good. The credit underwriting process remains robust. You're talking about, let's say, 30% sort of a growth on a quarterly basis. Even if, let's say, it goes through a time correction, there will come a point in time when the growth catches up with valuation. You will see the next round of move. That is how stocks move. They don't just move in tandem with earnings growth. They front end the earnings growth, stay there for a time correction, and the next round of earnings growth, they again move. You've got to see where you are. Where is the buying opportunity, where it is getting overextended, and then take your call as to whether you want to buy or hold or whatever.
Okay. Last couple of questions. One is, what in the recent 6 months or 9 months that the last we spoke in person was probably 9 months away or maybe something like that, wherein you've spotted a business, wherein you rubbed your hands in glee and said, wow, that looks fantastic. I mean, a theme, a sector, maybe a business, but we don't want to talk stocks really, but something out here wherein you really thought that this was an opportunity that you've been waiting for maybe for the last 12, 18 odd months, if not a lifetime.
So there are many names, and I think with the GST environment now underway, if you understand the dynamics of that business in the unorganized space, there are a plethora of opportunities even today.
Okay. You really...
Yeah, the electrical cable space, 60% of the market being in the unorganized space. So what do? I mean, there will be some players who are going to... I think the big round of multi-baggers is going to come from the shift from unorganized to organized.
But that's a very wide pocket, money.
Absolutely.
So where do you zero down?
So let's say the retailing space, okay? You all know, it's a shift away from the unorganized retail, and retail is going to be staying out here, whether it be the home delivery segment or whether it be, let's say, high street shopping areas, etc. So these would be the areas where there's going to be a massive shift from unorganized. You have opportunities there. As I told you, the consumption, discretionary spaces, you're going to see massive consumption shifts out here. These are some of the areas which I think can create some very interesting names, going into the next many years.
Okay, last question on the show. What's recently in the last 6 months the best book that you've read?
So I'm reading a book called Scale.
Scale. Okay.
That's a fabulous book. It allows you to think about how to project or how to look at what is the limit to which the extended trend can go. What are the changes in the trend? How do you analyze? How do you project the dimension of the problem? Let's talk about, let's say you have X percentage of people coming from, let's say, the villages to cities of India, right? You required this sort of infrastructure for X population. What is the sort of infrastructure you're going to require for X plus Y population? It allows you to think about the magnitude when you are looking at scalability of anything. Where is it that you can lead to? And where is that opportunity?
Do you remember the name of the author?
No, I don't, but it was some foreign author.
Okay, Scale.
Scale.
We'll remember this. Okay, Manish Sonthalia, thank you so much for taking the time out and
this is a
speaking to
book
us.
actually
Sorry?
which has been recommended by Michael Mauboussin. So, you can just Google that, and it's a brilliant book, I would think.
Okay, great. Thanks so much for that recommendation. More importantly, thanks so much for agreeing to be a part of this show. Much appreciate you spending the time.
Thank you so much for your time.
And viewers, thanks so much for tuning in to yet another episode of Alpha Moguls.